All right, cool. So we'll go ahead and go into types of trends. So our main basic are, there's basically different ways, data tends to evolve, and we can actually see these kind of things, and we can actually look out for those kind of trends. So the first one we should talk about is stationary data. And so basically stationary data means that there isn't really a trend, which is good. You guys want to say, is this data stationary, or is it in fact changing over time in some way? And of course, when something's changing over time, usually it means that some other factor has come into play, and that's an important part of what we're looking for. So a few things to know is that basically stationary has a pretty strict definition of what this means. Actually got these images from this blog specifically, but basically it's that the mean, the variance, and the covariance do not change over time. Okay, so all on the screen here are stationary data, and you can see that there's still fluctuations, there's still changes over time, but the data in general doesn't like fluctuate from that kind of like if you imagine like drawing a line through there, and it'll never really change from that line. Okay, even though any single data point will probably move over time, but you can see the data can change maybe differently in here. So for the first obvious one is if the mean is changing. So if the mean is changing, basically, essentially you draw a line through it, right? And basically that creates an average. And if that mean is changing over time, it's not stationary. So this, for example, would be an upward trend, okay? Another one is variance, which is a little more subtle, but basically the variance here is saying like how, what's it called? Like kind of a distribution, like, how much does it vary? How much does it change, within that time period? So maybe, for example, this is like per year, but you can see like there's a wild fluctuation over here versus a very small fluctuation over here. This one right here, basically, it's like, oh, variance is changing over time in some form or fashion. Another one could be like, you start off very small, and then I guess I should probably just annotate that, probably easiest. So like if you imagine, if you have, why can't I draw? Sorry, guys. There we go. Okay. So if you imagine your data, for example, starting off very small fluctuations to very large fluctuations, okay, we have a higher variance. And if you remember back when I think probably section or module 1, we talked about heteroscedasticity, which I believe I spelled that. Did I spell that right? I don't know. Oh, wait, no, C or K? I think it can be spelled either way. I don't know. You guys let me know. But you can imagine heteroscedasticity, basically, is there a change in the variance over time? So if you remember back in those plots where we basically did the residuals and we saw like, oh, are the residuals evenly spaced, or is there some pattern to it? That's essentially this equivalent to here, okay? And then the last one we have is covariance. Covariance is a little, in my opinion, a little subtle, but basically you can think like we have here are very periodic time periods, but instead what happens is that we actually have, like you can see it getting squished over here. We now have basically things are changing over time where maybe things are happening, the frequency of that period is happening. That's confusing. The period's getting smaller, for example. And that would be an example of covariance. Basically something is affecting it in the sense of saying from this time period to this time period, it's not the same, okay? So it's kind of like, you can think of like covariance as like variance along the time axis itself. It's varying across that time versus varying across the X value. Okay, cool. Any questions about this? Okay, cool. But yeah, anyway, this is stationary. Basically, this is kind of our definition of like, if it's stationary, there's no trend. So just kind of be aware of that. So then obviously our no trend data, here's an example. This is from the curriculum too, I think it's from the stock exchange. You can see that there's variance. I mean, like it varies over time, but in general, there isn't a strict trend. There isn't anything in particular that is making a difference. And this is one of the reasons why it was kind of hard for us to actually like look at any patterns in the visualization, but something to kind of think about. So main thing is like, oh, if it's stationary, there's not really a trend there. We actually have tests that we'll talk about in a second, but if it's not stationary, obviously we have different kinds of trends. So the different trends we're going to talk about is linear trend, exponential, periodic. And this one, I'm just going to show you guys different graphs. The curriculum actually shows, how to reproduce some of these things and kind of goes into a little more detail. But again, linear trend, pretty straightforward. This is usually what we see. It's basically if you can draw a line through the average of this and you see a general trend, structure. So even if it's periodically going up, you might see a trend going there. And these tend to be pretty common, for example, for different growth. For example, this one, for example, UK imports. So a lot of like what's it called, like agencies that are growing over time kind of deal, you will tend to see this general linear trend. And that's not always true. We'll see, for example, we'll have something called an exponential trend, which tends to be when things get multiplied over and over again. But if you have something where you're growing, for example, if you just have more people, you basically will have a bigger, production, for example, you would see a linear trend, okay? Either upward or downward. Okay, and then, so next we have our exponential trend, which is pretty good. Like exponential trends tend to look linear at first. So this is actually a really important part. It's like at first linear, exponential trends will start linear, and then you'll see that it'll take off. So if you drew, for example, if you took like from 2015 to 2012 and you drew a line through that point, you'd have about a line. But then as we get into further amount of time, we can actually see it goes exponentially. So this is kind of like a classic for growth, is that you'll tend to first see a linear trend, and then over time, with enough time, you'll actually see an exponential curve. And so this is where it's kind of like, tough. This is where actually big thing in the stock market is like, which is a linear growth versus an exponential growth, and trying to figure out, what those patterns are supposed to look like. And it just turns out at the very beginning, just because of the nature of like how exponential works mathematically, you'll tend to see a linear trend at the very beginning, okay? And again, exponential tends to be when things are essentially increasing. So for example, you are making more, like a business making more money, so you're able to hire more workers. You're hiring more workers, meaning you're more productive. Because you're more productive, you're making more money, and so on and so forth. You basically building and building, higher and higher up. And basically, as you increase your, you increase faster. So one example I talk about this is like your snowball of knowledge. If your snowball of knowledge starts really small, you can get more and more knowledge, but your snowball grows very quickly. The volume or the area of your snowball grows very, very quickly, compared to, if you start off with like a line where you just keep adding more and more. Instead, if you're adding more and more on the outside, your snowball gets very, very big. So it's more of an exponential growth. Okay, cool. All right. And then we have our periodic group, which is probably pretty common, like, we see in stock exchange, or, when we talk about time series that have some kind of frequency. So here we have a periodic table or periodic data, and we can see it kind of goes up and down, up and down. There's not really a clear, like, what's it called? Like, we can see there's a pattern in there, right? Just going up and down. But if you look at this closely, even though it's going like this, there isn't really like a clear, like going, like, like, oh, from 1984 to 1986, there's not a clear, like, increase. In this case is temperature, right? Even though it's periodic, right? But here, I actually know what this data is. This is from the curriculum too. You can see it's also periodic, going up and down, but you can actually see there is a trend that's going upwards in this case. And so it seems to be going upward, even though there is a periodic part. So just know that just because it's periodic doesn't mean there can't be a trend within that period. All right, any questions about any of the trends I showed you guys? Okay, again, curriculum goes through a lot more detail in it too, and how they produce.
I have a question. Can you describe data as more than one of these kinds of trends? Or does that make sense?
Yeah, no, that makes sense. For example, periodic would probably be the most common one you'd combine with like a linear trend and an exponential trend in that sense. So you might still have something that is periodic, but it's going upwards in some exponential fashion, or in some, what's it called, linear fashion. So a classic one for this, for example, is the carbon dioxide one, which I feel like I should just show you guys that graph. So if you have, so I keep talking about it. Come on. Yeah, this is pretty close. So I don't know if this data is accurate, but it looks something along those lines, where you have this up and down, but it's still going up and up and up. Oh, here's a better one. I didn't notice it. So you can kind of see here is that we have that up and down, but in this case, we are in fact increasing. It looks like closer to a linear trend here, and they drew that average in the middle right here. So this is where we have a periodic part, but there's still some kind of trend besides just it being periodic. Does that kind of answer your question, Stephen?
Yeah, also, I guess it would be really dependent on the context of how much of the data you took to look at.
Absolutely. Because
if you only took a little bit, like, oh, wow, it's exponential, and then you kind of zoom out a little bit, like, oh, no, it's not.
Yeah, there's a famous one called the S-curve, for example, where things tend to go up like this, and it's like, oh, exponential, but then at a certain point it starts plateauing, and that's an S-curve. And basically time series all comes down to saying, because this looks like an exponential curve. So like if you were to like extrapolate from here, you might say, oh, we're going to keep going in this direction. But in reality, it's like, oh, it's an S curve this way. So this is where context really helps in modeling. Essentially what modeling is like, hey, what do other curves look like in similar situations, and try to predict what's afterwards, which of course ends up being really difficult, which is why it's really hard to make money in the stock exchange, because it's hard to predict trends. So cool. All right, guys. Any other questions before I move on to the last thing? Okay, cool. So I know we have a few more minutes. So I think, okay. And then section 6 and 7, I'm going to save for next time. But just quick thing about assessing trends. This is within the same section that we talk about types of trends. There's basically two main things we can do. At least the curriculum talks about assessing trends. So here I'm just producing some random data. So you can see here, in this case, I believe it was supposed to be exponential growth. Yeah, so you can see right here, it's being exponential. So basically we're adding up more and more and more, okay? So we're just making some data just to make it look interesting, right? And so one thing we can do is something called a rolling statistics. And what that basically means is that you take, instead of every individual point, compare this point with the next point, you compare, you average over a period of time and compare those points. So for example, here's one that we actually, this is again from the curriculum. I won't go into the full details, so you can look it over. It's not too hard to read through. But basically, here's the original data in the blue. Okay, as you can see, like there's a periodic table, and instead of saying, okay, like looking at every individual point comparing the next one, we instead average over 8 different points. So we basically take 8 different points, 1, 2, 3, 4, 5, 6, 7, 8, and we average them together and say, all right, that's my data point. And then from this data point, we take the 8 previous ones, 1, 2, 3, 4, 5, 6, 7, 8, and basically not that last one. And that's our new data point. And basically the same thing from here. We take the 8 previous data points and plot it from here. And this is called a rolling average. So basically the idea here is like, we're taking like a slice, like I imagine like you're taking like a slice and you're moving that slice with you. So you say, all right, whatever's in this slice averaged together, that's my new data point. And you move it over, my new data point, my new data point, my new data point, going all the way through. And that creates a rolling average. So that's what this red line means right here. Okay, and that's pretty common where we have something where something fluctuates in some periodic fashion that maybe we don't really understand exactly why it's periodic, but we do see there's a trend. So we want to see that what that general trend is. We can see that here. Right here's also this rolling standard deviation. Okay, so you can see the rolling standard deviation in this case is basically just doing the same thing. We're taking finding the standard deviation within that period. So that way we can see. And so this would be useful, for example, seeing if it's stationary. Is the variance changing over time? Is the covariance changing over time? Things like that. We can do that by rolling it over. And you can see the standard deviation from this part doesn't actually change, but the mean does change. So this is basically saying, oh, it's pretty consistent with how its period goes through. There's not a huge amount of distribution or change in that distribution, but the mean itself is changing. Okay. And obviously this part right here, this will depend on context and like what matters. So for example, if I put something like, let's say 20, you can see it gets to become a lot smoother, and that's because I'm taking 20 points. So our average obviously will be a lot smoother. If I do something like, like 2, okay, you're gonna see our average move a lot different because obviously there's more fluctuations within there. So it's all depend on what makes the most sense. Okay, so obviously if I do something like 50, like that's gonna be almost nothing, right? You say, okay, like, well, I'm taking that huge average over time. So again, just context. Cool, any questions on rolling averages, rolling statistics?
So the taking the rolling means a little different than downsampling for the mean.
Right. Yeah. In downsampling, we're more like trying to look at specific parts. We're trying to take something that is like a daily, let's say like example, a daily data and making it into a monthly data. This one, we're trying to just see the overall period. So we're actually looking at that whole period, for example, let's say daily, but we're taking it over a month and we're moving that monthly average over. So we get basically the changes in day, but we're just doing it over a longer period of time. Okay, cool. And then the last one is the dickey-fueller test. Okay. I didn't write too much about this part. There's a resource here. Curriculum talks about it. There's some code here, but basically it's a statistical test on if the data is stationary. So basically I don't know why this got messed up. That should be the null hypothesis. So the null hypothesis is that this time series is stationary. Alternative hypothesis is that it's not stationary, right? And basically it's a t-statistic. It basically is making like a t-test on whether it's stationary or not, okay? And so you can see these values and then we can you can see that this is the values. And again, play around with this. I would say strongly look at the documentation to see, like, understand what's going on here. But basically at the end, it's like, oh, it's a statistical test. You get a p-value, you get a test statistic to say, all right, is this stationary or is it not stationary? Or is it, like, how likely is it by chance that it's not stationary? Okay, cool. All right, so that ends my time. You guys have any questions on anything to talk about, whether it's assessing the trends or anything else that I walked through?
I was wondering something about upsampling.
Mm-hmm.
So when you fill in like data points for upsampling, you're just kind of putting in like fake data, right? Like it's not random, it's kind of close, but it's not real. So you said it would be useful if you were combining it with something. What would you be combining it with?
So for example, like let's say like this is the mean, and I want to combine it with like this is the daily mean, but let's say I find data that actually has per hour, right? And I want to combine it in the sense like, oh, like I want to use that daily average. Like I have this information from, like, let's say from another city, and I want to compare it to this city, but all I have is the daily average. And right here I have something like is, I don't know, per hour. And I want to compare those two together. Now, obviously you have to realize from context, like, well, my daily average is not going to be the same as this hour. So this is probably not the best example. In fact, it'd probably make more sense to downsample this one into an hour, like a daily thing. But if you wanted to, for example, combine these two parts, or for example, let's say this was a bi-daily data already, like you knew by context this was being recorded at 12 p.m. every night, or like, yeah, 12 p.m. or 12 a.m., right? So 12 a.m. every day, and you want to combine it with data that was already done every hour, you would upsample. So you can say, okay, well, I know this was recorded at 12 a.m. and I want to put this together. So I can say, okay, here's at 12 a.m. and here's the ones for hourly. And you might, for example, just fill it with an empty spot, like a null value.
I see. So it's like a trick to make it commensurable with another time series.
That's right, yeah. And a lot of times we might not have the full information on the hour, but you might know in the context of where your data is coming from if it was collected at a certain time. And that's something you can add into there for later. Okay, cool. And then I guess another example would be like if it was collected on every half hour. So like your data was collected every hour, but the other data was collected every half hour between those points. And you would combine those together. Well, obviously you can't just simply combine them together. You have to say, well, what was the missing part in here? Okay, we'll upsample, so it's every 30 minutes. And this one's every 30 minutes, even though it's an hour on here. And then you can combine them together. Okay, cool, good question. All right, anything else you guys have?
No, this is awesome. Thank you so much. So well organized.
Thanks. Thanks. And it is on the GitHub too, so you can reference it. And then this recording, I should go ahead and stop recording, but this recording will be put up hopefully within a day. Usually it takes me a day to upload it and everything. So I could stop this.